Hello, and thank you all for joining. Today we have a very special webinar for you all, which revolves around how to build your own financial plan. And as a financial planner, it gives me great joy to see so many people on this webinar because this is my bread and butter, so to speak. And I'm very happy to share the knowledge that I've accrued over the years through building financial plans. But before we begin, let me give you an overview of our team and agenda. And first, as always, a quick note from my compliance department. And additionally, I do want to say I will be opening up to questions at the end. So if you have any questions, just hold on until then. Now, we're a boutique wealth management and financial planning firm here in Irvine, California, but we do have clients across the entire nation. And what we do with our clients, many of which are on the line today, is we work with them on their holistic financial planning and investment management needs. I found that our industry is just a little too focused on really just the investment side of planning. So we've made it a priority to take a comprehensive and to take a holistic approach to the planning that we do and to continuously educate, which is one of the reasons why we host this webinar series. Now, our planning process involves first building a well-designed financial plan for the clients that we work with, and then organize our clients' investments directly in coordination with that plan. And then we ensure that any outside planning items are taken care of, whether they are directly assisted by us to execute on them or through other professionals like CPAs or attorneys. And here's a quick overview of our team. Within the firm, we have 7 planners, myself included. We have a retirement plan specialist, an investment specialist, and then 3 administrative assistants. But enough about us. Let's get into today's topic, which is comprehensive financial planning. Now, comprehensive financial planning involves an array of planning topics, shown here from retirement planning to estate planning to all the individual subcategories within the planning pyramid. And when building a financial plan, you want to be sure that you're accounting for all of these variables and not just focusing on one or two. So for today's conversation, we're going to help to educate you on the various areas of planning so you can either get started on a very own plan for yourself or just improve the plan that you may already have in place. We'll first off discuss the reasons why financial planning is important. Next, we'll discuss the 5 or the 5 biggest planning mistakes and review some of the strategies on overcoming those issues. Then we'll discuss the specifics to building a plan for yourself, and lastly, touch on any next steps. So, why is financial planning so important? Why would I dedicate my entire life's career to this one topic? Well, it's important because proper planning prepares you for future life events. And shown on the right are some of the major aspects to life that a financial plan is going to help with. From ensuring that you have planned for retirement, to properly accounting for inflation, to investments and beyond, a financial plan will help you prepare essentially. And overall, a financial plan is just a roadmap. And summarized here, comprehensive financial planning is first and foremost goal and solution oriented around your specific needs. It is holistic and integrated. It's short, intermediate, and long-term focused. And just as important, it's proactive. Typically, it's going to involve having some sort of coach, advisor, or confidant, someone you can turn to for advice. And then lastly, it is not just focused on rate of returns, but more or less focused on achieving your individual vision. But as you can see, financial planning is not necessarily simple. There are a lot of details to it. And because of that, people can make mistakes. So to begin, I'm going to get into the 5 most common planning mistakes that I've personally seen as a financial planner. And for each, I'll review some of the strategies on how to overcome. So let's begin with the first mistake that I see, which is not having proper savings and spending plans. And what I want you to understand here is that this is not a budget. What this is a well thought out and organized way in which you manage both your inflow and your outflow of money to optimize your investments as well as minimize kind of unwarranted expenses. And what a well thought out saving and spendings plan will address is first pre planned contributions to various investment accounts so you know how much you're saving and how exactly that's going to affect your future. This in turn will give you a certain level of assurance that you're properly saving enough for your future retirement. Next, it will provide you more or less a general allowance of money that you can spend on weekly, a monthly basis. And lastly, it will help you plan for excess cash flow so you know where to position those funds in the event that you do have excess. And the strategy that I recommend for my clients is called paying yourself first. And this is essentially a turnkey strategy to ensure that your paycheck is positioned exactly the way that you need it to be positioned for your long term objectives. And this is how it works. First and foremost, you need to have an idea of how much you need to save for retirement, and then back into how much is required on a monthly basis to save into your 401k or potentially your other retirement account. Then what you do is you just set up those automatic retirement account contributions from your paycheck to go into this account and to be invested. From there, the excess money then goes into your checking account and should automatically be contributed to really whatever buckets of planning you have allotted your cash flow to. For example, if you wish to save for a home and you need $60,000 saved up in 1 year as a down payment, then you'll need to tuck away $2,500 for 24 paychecks to get there. And lastly, the beauty of the strategy is that there's really no set budget. Once you have essentially positioned your money correctly to the right avenues, you just spend the excess that accrues in your checking. But overall, I love this strategy. I do it for myself. I help a lot of clients with it. And ultimately, it helps to ensure that you're just sticking to your financial plan and preparing for those future goals and objectives, whether that be retirement, purchasing a house, college, really could be anything. So, on to mistake number 4 then, which is not properly managing life's risks. And there are a handful of risks that we are exposed to on a day to day basis. And if we tried to manage all of them, we'd probably drive ourselves crazy. But there are some risks that are so detrimental to your long term financial planning health that it is worthwhile planning and preparing for them. So, what are some of those life altering risks? Well, first and foremost, there is having a large unplanned expense that could leave you in crippling debt, you know, like a healthcare related expense. There's the risk of liability, like getting sued after someone slips on your property or after you accidentally hit someone in your car. The risk of dying too young and leaving your spouse or your children in an unfortunate financial position. The risk of being disabled and not being able to maintain your income. The risk of long term care or outliving your retirement portfolio, which often go hand in hand. But overall, there are a lot of risks. But most of these risks can be covered with insurance. Now, my recommendation is not to go out and just buy a bunch of insurance for each of these risks. However, a part of planning is being aware of the risks and determining which you want to self-insure, what you are comfortable just handling on your own, and which you'd prefer an insurance company to use or to use an insurance company for. Which leads me to many of your options. So auto, renter, home, and health insurance, that's what's going to help alleviate many of those unwarranted major expenses. Umbrella insurance can assist you in the event of a substantial liability, like hitting someone with your car and they sue past your auto limits. Life insurance can protect your family in the case of a premature death. Disability insurance will cover your income if you become permanently or partially disabled. Long-term care insurance will assist you with potential long-term care needs in the future to help you cover those costs. And lastly, annuity products can help to avoid possibly running out of money if you purchase the right type of product with the right type of insurance company. But once again, do not go out and do not buy each of these products. Do this first. Ask yourself some questions. What coverage is offered through work? Many times, disability coverage, which is one of the most expensive risks to cover, can actually be purchased through work at a significant discount. So before going out and buying some large private policy through an insurance agent, review your options. Ask yourself, what is my retirement deficit? Meaning, how much more money do I need to save to retire? And if I were to pass away right now, would my family be able to reach that objective if I were gone? Then you can decide on potential life insurance needs. Do I have other income sources if I were to be disabled? Or the biggest question of all, would I be able to maintain my current position if I was disabled? If I personally was disabled, I could probably continue to do what I do now, but someone working out on the highway, someone working with their hands, they might not be able to. Do I have such a large retirement portfolio that I could handle future medical costs arising from a potential long-term care contingency? Do I even need to insure this risk? What is my current liability coverage and what is my net worth? Many times, if you are at fault for an accident, people may attempt to sue past policy limits on either your auto or your home insurance. So you may want to tack on some additional coverage in the form of an umbrella policy just in case you were to be sued. And lastly, what do my retirement income projections look like? If I haven't sufficiently saved, then I might not be able to cover all of these liabilities because personally, my excess cash flow may be best positioned towards retirement rather than insurance. Once again, you don't necessarily need insurance for every single risk, but you should be thinking through these questions and bringing them back to your individualized plan. But enough about the risks. On to mistake number 3, which is not having a retirement income strategy. And that's essentially the strategy that you utilize to determine which accounts to pull from and when to reach your retirement goals. And there are 3 steps when first starting to develop kind of this strategy, which is 1, when are you going to retire? 2, how much income do you need once you're retired? And 3, how long is retirement going to last? These are not the easiest questions to ask yourself, but they're necessary when properly building out that retirement plan. And the first question to ask is, when are you going to retire? And there's a few things here to consider. The main being that if you retire early, you are going to have fewer accumulation years to save, and you are going to have a longer distribution period for your savings. You will potentially also have missed employer retirement contributions. Your Social Security benefit will probably be lower, and you'll have higher healthcare costs. And lastly, your pension benefit may also be reduced. The opposite are true if you delay retirement. And when asking yourself, how long is retirement going to last? Understand that we as humans are living longer lives. The average 65-year-old can expect to live approximately to age 85, and life expectancies are on the rise. So retirement may last 20 plus years for some, and you need to be certain that you've planned for all the expenses that are going to arise. Which leads me to understanding the logistics of your retirement income. And as a general rule of thumb, and once again, this is just a rule of thumb, you need about 60 to 90% pre-retirement income, mostly due to the fact that your taxes are going to be lower less in retirement, and you might be saving less because now you're distributing. But this is just a rule of thumb. What is important is to model out your retirement. What expenses will change? What pursuits do you want to spend money on? List your expenses and then project them. And that will help you better understand how much you're actually going to be spending. Additionally, there are 3 main ways you'll have retirement income, and they're all going to be taxed differently. First off, Social Security, then employer pensions and retirement plans, and lastly, whatever individual savings and personal investments that you may have, whether that be stocks, bonds, rental properties, or something else. Now, I'll talk about the modeling later on, but what's important to know here are that all these various income sources are all going to be affected by tax slightly differently, and you need to be aware of this. Pre-tax retirement accounts, interest, dividends, and most pensions are most likely going to be subject to ordinary income tax rates. Non-retirement assets, non-retirement investment accounts will most likely be subject to capital gains tax rates on any gains above your cost basis, what you purchased that investment for. There are many investments that are tax-free, like Roth IRAs or many municipal bonds, the interest that you receive from them, of course. But overall, you do need to plan for tax. And also, you need to position your portfolio ahead of time to reduce tax as much as possible. Because I like to say it's not about how much money you make through your investments, but it's about how much money you make and then keep in your pocket through proper tax management of those accounts. Because taxes can be a huge drag on your investment portfolio, and you do need to plan for that. And that's a good segue to our next slide, which is mistake number 2, which is not having an investment policy statement. And essentially, what an investment policy statement is it's going to be a document that outlines the general rules for the management of your investment portfolio. It's going to provide you your general investment goals and objectives, how to structure your portfolio, outlining your risk, and what specific allocation you'll have of the asset classes. And then it also accounts for any special circumstances, like tax management, for example, what we just mentioned. But overall, this investment policy statement is going to be your investment strategy within your overall financial plan. They essentially go together. And with this investment policy statement, one of the very most important things to be aware of is going to be your risk. Now, risk within a well-diversified portfolio is really just the risk of volatility, meaning that your portfolio could go up or go down in a moment's notice. If you're diversified, risk is not, and I repeat, it is not the risk of losing all of your money. It's really just a measure of volatility. So when it comes to understanding your specific risk, you should first be aware of the risk-return trade-off. On average, the more risk you take, the more return you receive in the long run. Secondly, you should be aware of what your personal tolerance to risk is. Third, review your income needs from the portfolio. And lastly, which is very important, is understanding what exactly is the rate of return needed to achieve your specific goals and objectives. For example, after developing your financial plan, if you realize that you only need a 3% rate of return to make it through retirement comfortable, but you're targeting a 9%, then maybe it actually makes sense to pull back on risk, which may improve your security and your long-term planning. But one thing that people fail to do is to diversify properly, whether they're a high or a low-risk investor, which leads me to the next slide. And what many don't understand is that diversification does not necessarily mean less return. Diversification, it just means less volatility, most likely, in your portfolio, aka less risk. And how I want to explain this concept is through what we call the efficient frontier. And what this methodology says is that for whatever risk level you may be at, whether you're a low risk investor or a high risk investor, there's generally an optimal blend of the varied asset classes that can potentially get you the most efficient rate of return for whatever risk level you are comfortable being at. And that involves most likely being invested in the majority of the asset classes. And there are more than what I'm showing you here. This is just for illustration purposes. And how I like to explain this concept is it's sort of like baking a cake. When you go into the kitchen and you bake a cake, you don't just grab a few ingredients out of the fridge and then throw them into a bowl. What you do is you follow a recipe that the cake calls for. The same concept applies to investing, whereas asset classes are the ingredients and your recipe is whatever you feel comfortable investing at, whatever risk level you feel comfortable investing at. All in all, once you determine your risk, you can then determine the exact mix of the asset classes to invest in, and then ultimately maintain that mix through ongoing management of your account. And what I want to mention is that investing is easy when the markets are going up and everyone is making money. But when the markets trend downwards is sometimes when people make portfolio altering decisions that dramatically affect their long-term rate of return. And an investment policy statement helps you to avoid making those altering decisions. One of the worst things you can do to try to do is time the market. And this is what a lot of people do when the market is going up and down and they get nervous. They might get alarmed, they might get frightened. And I've seen time and time again investors make horrible decisions. For example, during the COVID crash, the 2008 crash, and quite frankly, anytime there's volatility in the market. And what I want to show you is that generally, those that try to time the market and that are active in their portfolio lag passive investors dramatically. And it can be seen by this chart here. So this is a chart from 1992 to 2021, where there was a lot of volatility in the market. We had the 1998 dip, the 2000 tech bubble, the 9/11 crisis, and the 2008 Great Recession, and the COVID crash, and a lot of volatility in between. But if you were an investor in just the US markets during this time and you just stayed passive, meaning you weren't trying to time the market, on average, you received a 10.65% rate of return average per year. But because of the volatility, a lot of people tried to time the market. And those that did, on average, only received a 7.13% return during this time period, over 3% less than those passive investors. Now, what an investment policy statement is going to do is it's going to help you stay disciplined, and it will help to not necessarily avoid the volatility, but avoid the mistakes and the emotional investing that happens during the volatile times. So overall, I just want to say before getting to the last mistake that an investment policy statement will do three things. It'll help to ensure that you are invested to the risk that you are comfortable being at. It'll help to hopefully get the highest rate of return for whatever risk you're comfortable at. And lastly, it will help to avoid making emotional decisions that could dramatically affect your long-term portfolio return. So on to the last mistake, which brings us full circle. And the last mistake I see is most people don't have a written and a holistic financial plan. And that leaves the door wide open for misguided steps, missed opportunities, or potentially just emotions getting in the way of your planning. So what I'm going to do here is talk a little bit about what you should consider when developing a financial plan, and then get directly into the logistics of building a plan for yourself. And first and foremost, you should set what we call SMART goals: specific, measurable, attainable, relevant, timely. This goes back to what I said at the beginning about how planning should be centered around your goals and objectives. And with retirement, there is a lot to consider. It's not all about just how much money to save. Does your retirement revolve around true financial independence, or do you plan to, work in some capacity? Will you be spending more or less money on various items such as travel or new hobbies? Do you plan on staying where you're currently living at? Is there a desire to leave an inheritance for your children or your grandchildren? There are a lot of questions around this type of retirement that you may want, and it's important to ask yourself all these questions well in advance. And secondly, when will you retire? As I discussed earlier, the earlier you retire, the more financially straining it will be on your accounts. However, there's always levers that you can pull if an early retirement is truly what you desire. You just need to plan it out. And then lastly, how long is retirement going to last? Ultimately, there's a lot that goes into planning and planning for retirement. And as much as it is financial, it is also psychological. But this doesn't mean that you shouldn't account for all the financial variables as well. For example, when building out a plan, think about your expenses. Expenses at the start of retirement will not be the same as when you pass away. A lot will change, and those changes should and need to be reflected within your financial plan, whether that be inflation, rising healthcare costs, future long-term care needs, large gifts such as maybe paying for a child's wedding, or additional travel costs should be accounted for. And if you don't account for those, and if you underestimate, then you could be leaving yourself in a non-ideal situation. And just to give you an idea using real numbers, like I mentioned earlier, many retirements may last about 25 years. So what would happen to the value of your dollar during that time? And given a conservative inflation rate of 3%, the value of a dollar will get cut by more than half during that 25-year time period. So if you're spending $50,000 today, then in 25 years, given a 3% inflation rate, you'd be spending about $104,000 on the same goods and services. This is just one simple example that shows that it is imperative to account for the variables in retirement that affect your cash flow. So what does this offer mean for you? Well, it means that you should have a financial plan built out with proper modeling. It should be comprehensive and it should account for all future variables, not just today's. So what I'm going to do in these last few slides is give you the specifics to building a plan and provide you some of the next steps that you'll need if you decide to go down this planning path. And shown here are roughly the 6 steps needed. But we'll get into this in just a second because I want to first discuss the components of a comprehensive financial plan. And first and foremost, you need to identify your goals and your objectives. I can't express how important it is to identify these and then to write them out. Secondly, you'll need to review exactly where you are financially, and this involves taking an inventory of all your assets and liabilities and listing them out in an organized manner. Next, you want to project those assets out to see their potential for growth and where they probably will be in future years. You'll also want to take an inventory of your expenses and determine if your spending is sustainable, and then ensure that you project out all the necessary changes, accounting for inflation, for example. Next, you do want to assess your risk tolerance and review your investments to determine if those two are aligned. And lastly, you should use scenario planning to determine how certain changes may potentially affect your long-term planning to see if they're even reasonable to make. So with all that being said, I'm going to walk you through our firm's planning process on initially building out a comprehensive plan so you have an idea of what this actually looks like when it's implemented in real life. So first, as I mentioned, write out your goals. These should be organized by what is considered a short-term goal and a long-term goal. And as I mentioned earlier, they do need to be measurable. But once you've identified your goals, then you can develop some base financial modeling. And this type of modeling will do a few things. First, it will list out your balance sheet and show you where your net worth is held, whether that be in retirement accounts, non-retirement accounts, real estate, or something else. Next, you'll start with projecting out your income and expenses through short-term modeling. This is where you'll list out your balance sheet, including any assumptions for growth, and then separate your income and expenses. Doing this type of modeling will assist you in reviewing your excess income and will also help as you project your income into later years, as certain expenses will be added, others will be removed. Ultimately, this type of modeling is really just an exercise to get a handle on your current financials and then to help to determine what next steps you may want to implement. And you can also go back to this modeling and adjust it to see exactly how certain changes will affect your long-term planning. Now, the next thing you'll want to do is to analyze your investments. Investments are going to play a direct role in your financial plan because if your accounts aren't growing, then you probably are going to have to save a lot more money for retirement. So the first step is to do a true asset class analysis of all of your investments. This essentially means breaking down your investments, whether that be stocks, mutual funds, ETFs, or something else, and then individually categorizing them based off of what asset class they fall into. And from there, you'll be able to determine exactly how risky you are, as well as help to determine which asset classes you may be missed in your portfolio based on the analysis. Now, there's software that can help with this, or you can do it the old-fashioned way. But in the end, what you're trying to achieve is an idea of your risk, how your assets are positioned, and then lastly, what changes need to be made. And once you determine what changes need to be made, then you can really dig into the individualized asset subsets and work towards achieving a well-diversified portfolio that is directly in line with your risk and what you are comfortable with. But remember, investments are just one component of the planning, and after going through this process of developing that full, robust plan, you should ultimately understand your situation a lot better, and that leads me to the last step, which is developing your very own observations and recommendations. And then lastly, developing an implementation agenda and determine what steps are needed to begin implementing. Because ultimately, you've put all this work together to understand your situation, It's not an actionable plan until you take the actionable steps to better your financial situation. So with that being said, contact us if you have any questions. We do this for a living. If you're a client on the line and want to review your plan, update your numbers, or just chat, just know you can talk to us at any point. You do not need to wait until we reach out to you for a review. So if there's a major life change, if something's going on, reach out and let's put some modeling together to give you some clarity into the future. And for those that aren't clients, just know that our door is always open. If you'd like to ask us questions, talk to us about what a relationship with our team would look like, we're always here to talk. So just shoot me an email or contact us on our website. But with that, what I'm going to do now is open it up to questions. And I do need to close out the webinar for those that are watching the pre-recorded version. So I'm going to close out now, and those on the line can stay, and we'll open it up to a Q&A just shortly.